Welcome to the deep dive. This is your daily briefing, and well, if you've been watching the Bitcoin charts lately, you know exactly what we need to talk about today. Okay, let's unpack this. We've seen a pretty clear technical consolidation, right? Kind of a necessary shakeout after hitting that new all-time high. But the key thing, I think, from the data we're looking at is that this short-term selling, this profit-taking, it's being met almost instantly by what the analysts are calling a really powerful structural bid.
Exactly. It's a collision.
Yeah, collision. Short-term pain versus, well, deep-pocketed conviction.
And that collision, that's the real story here. It's actually a critical structural test for Bitcoin. The whole market structure is just far more mature now. It's dominated by these regulated players, these institutions that, well, we tend to call them price-inelastic.
Okay, price inelastic. For maybe someone who doesn't live and breathe this jargon, what does that actually mean for their investment?
It just means they aren't buying because the price is going up fast, chasing momentum. They're acting on long-term plans, allocation mandates. So they buy pretty much regardless of the day-to-day swings. The big question now is whether this newer, more institutional structure can actually absorb the normal stuff, the leverage clearing, the volatility, without those huge drawdowns we saw in, say, 2021 or earlier cycles. If it holds here, then that foundation above $100,000 starts to look really, really solid.
Right. That's our mission today, then. We're going to dig into the exact price levels you need to watch, look at these, frankly, jaw-dropping institutional demand figures, check out what's happening with corporate treasuries, that story's evolving, and also track the global regulatory picture, which seems to be converging. So let's start right there with the charts. The technical reset, we saw that dip breaking below $122,000. That felt like confirmation, didn't it? Profit takers, derivatives getting flushed out.
Oh, absolutely. Textbook deleveraging.
And the price has sort of found its feet, for now anyway, holding around $121,142.
Yeah, stabilizing. So now we look for where the smart money might be waiting. We've identified two pretty critical support clusters here. The first one, the immediate support. That's a tight range, $119,000 to $120,300. Holding that is key to stop any sort of immediate downward pressure.
Okay, 119 to 120.3.
But the real floor, what we call the structural support, that's a bit deeper, on-chain data shows a big, high-volume area between $117,000 and $118,000.
Meaning lots of coins were bought there originally.
Exactly. A huge amount of capital came in around that level. So those buyers, they're likely to defend that zone pretty aggressively if it gets tested. That's really the key level to watch on the downside. And $122,000, that's now your resistance point.
Analysts are, quick to label this a healthy correction or reset. But, if it's so healthy, how worried should you really be about that $117,000 level you just mentioned? What if the institutions don't step in there?
That's a fair point. Look, the concern isn't really about a total collapse, not with the current structure. It's more about momentum. If $117,000 breaks decisively, it probably signals a deeper consolidation phase. Maybe we test down towards $110,000 perhaps.
Okay.
But the reason analysts call it healthy is, well, the technical indicators were getting really stretched, very overbought. This pullback lets the market breathe. It allows it to build a more stable foundation, a higher aggregate cost basis, clearing out some froth, and that's often what you need before making a sustainable push towards the next big psychological number, which, projections are putting somewhere around $144,000 to $150,000 maybe in the next few months.
Right. So the short-term pain is running headlong into that long-term capital. Let's dive into those institutional numbers because, honestly, they are staggering. BlackRock's Bitcoin ETF, IBET, it just crossed a milestone that's hard to even wrap your head around. Over 800,000 BTC under management.
800,000.
Yeah. And this came after a 7-day streak of positive inflows, pulling in over $4.1 billion. Just think about that. One single ETF now holds about 3.8% of all the Bitcoin that will ever exist.
The scale is it's unprecedented. And IBIT's the leader, sure, but the entire complex, all the U.S. spot ETFs, they just logged their 8th straight day of net positive inflows.
Wow.
Nearly $6 billion flowed in during that period alone. That tells you this mandate-driven buying, it's relentless.
So this is the shock absorber you were talking about earlier.
Precisely. That's the defining feature of this cycle compared to previous ones. This constant, pretty inelastic demand, it acts like a giant cushion. So whenever the short-term folks decide, okay, time to take some profit, sell into strength, there's just this wall of institutional money waiting to soak it up. The price doesn't have to crash down to find buyers like it used to.
Right.
It's what's preventing, or at least mitigating, those really deep, scary drawdowns that characterize past cycles.
Okay, now let's shift to corporate treasuries because we do have a visible change, at least temporarily. The biggest player, MicroStrategy, or Strategy as we often call them, they announced a brief pause in their Bitcoin buying. Just 1 week, late Sept to early Oct.
Yeah, that was noted.
And we track their buying so closely, right? So even a temporary pause from such a consistent source of demand, it gets noticed. And of course, interpretations are all over the place. Maybe they had trouble raising capital. Maybe it's just a strategic shift in how they raise capital. What's the bigger picture?
I think the bigger picture is that the whole corporate treasury idea is, it's graduating. It's maturing beyond just relying on one company's, frankly, incredible ability to raise capital.
Okay.
The support structure is becoming more decentralized, more diverse, and honestly more sophisticated.
How so? What are you seeing?
Well, we're seeing companies move beyond just, holding Bitcoin passively. Look at NetBrands Core, NBND. They're building what they call a layered treasury. So Bitcoin is the main long-term asset, sure. But they plan to use yields they generate from staking other assets like Ethereum or Aave to systematically buy more Bitcoin. That's active treasury management, integrated with yield generation.
Interesting. So using DeFi yields to stack sats, essentially.
Pretty much. And then you've got others like DevStream, DEVS. They hold Bitcoin, about 22 BTC, alongside Solana. And they're actively staking that Solana for income. It shows a multi-asset approach that's tied into their business, which involves tokenization.
And we also mentioned Vault's Capital, V3TC, last time.
Right. Their whole business model is basically built around participating directly in Bitcoin's infrastructure.
Yeah.
They're starting with cloud mining, and the Bitcoin mine goes straight into their treasury.
So the takeaway here is diversification.
Diversification and integration, yeah. The corporate bid isn't just one whale anymore. It's becoming this ecosystem of different strategies, often tied directly to how these companies operate.
Yeah.
That makes the overall market support much more resilient, much less dependent on, Michael Saylor selling more stock.
Okay, shifting gears again, let's talk TradFi integration, a huge signal here. S&P Global just launched the S&P Digital Markets 50 Index.
Yeah, it's a big one.
And it's not just crypto, right? It's a hybrid 15 major cryptos plus 35 crypto-linked stocks like miners or exchanges, and they capped the weighting at 5% each.
The implication there is massive, especially for really conservative capital. Think huge pension funds, university endowments.
Their mandates often stop them from buying Bitcoin directly.
Exactly. But they can often invest in a recognized index from a provider they trust, like S&P. So this index creates a compliant wrapper. It basically reframes crypto exposure. It's no longer this weird, niche, speculative thing over in the corner. It becomes just another manageable slice within a standard diversified portfolio. It legitimizes it for the really big, slow-moving money.
And staying on that TradFi theme, but looking at the plumbing, Citi Ventures, Citigroup's VC arm, just invested in BVNK.
Right, the stablecoin infrastructure platform.
They're processing, what, over $20 billion a year in volume already? This feels like a classic picks and shovels bet, doesn't it? Betting on the infrastructure, not just the price of Bitcoin itself.
Precisely. Citi isn't just speculating on price here. They're signaling a conviction that stablecoin payments, a cross-border settlement using this tech, isn't just some future possibility. They see it becoming a core piece of the actual global financial plumbing. It's about embedding these digital rails right into the foundation of traditional finance. And speaking of foundations, we should probably mention the macro backdrop here, too.
The U.S. government shutdown.
Yeah, now into its 10th day. Events like that, prolonged uncertainty at the sovereign level, they just subtly reinforce that long-term narrative for Bitcoin, don't they? As a potential hedge against systemic risk, against currency debasement, makes those digital rails look maybe even more appealing.
Okay, let's look under the hood with the on-chain data. It gives us clues about who's actually doing what during this pullback. We're seeing something analysts are calling the great wealth transfer.
Yeah, the divergence is really clear. You've got the oldest, largest wallets, the mega whales, the folks who got in super early. They're distributing some supply, taking profits into this strength, which, makes sense.
Perfectly rational.
Absolutely. But the fascinating part is who's on the other side of those trades. Who's absorbing that supply? It's the mid-sized entities. Wallets holding between, say, 10 and 5 in BTC.
The crabs and fish, in Glassnode terms.
Right, those cohorts. And Glassnode's accumulation trend score confirms they are accumulating pretty strongly right now.
Okay, so explain the structural effect. Why does it matter that coins are moving from these very early low-cost sellers to newer buyers who are getting in at much higher prices?
Because it fundamentally changes the market's foundation. It structurally raises the aggregate cost basis of the entire network.
Meaning the average price at which all coins were last moved.
Yeah, essentially, yes.
Mm-hmm.
Coins move from holders whose cost basis might be near zero. They have almost no pressure to sell unless the price is astronomical, to buyers whose cost basis is, 115K, 120K, wherever they bought in recently.
So they're more committed at these levels.
Exactly. They have conviction at these higher prices. This whole process strengthens the underlying support levels. It means the market just has a much higher psychological floor than it did before. And that significantly reduces the risk of those deep cascading sell-offs we saw in the past.
Got it. And finally, let's touch on regulation. The global picture keeps moving towards clarity, which is probably the biggest long-term de-risking factor of all. We saw news out of Kenya.
Yes. Kenya's parliament passed their VASP bill, 2025. VASP, standing for Virtual Asset Service Provider.
Okay.
And this is really significant because it provides a clear blueprint that other emerging economies can potentially follow. It sets up a proper licensing system, assigns oversight, central bank, capital markets authority, and crucially, mandates full compliance with international anti-money laundering rules, the FATF standards.
So bringing crypto out of the shadows.
Precisely. Moving it out of the regulatory gray zone into a formal, supervised market. That's absolutely essential before really large-scale global capital can feel comfortable allocating.
And meanwhile, in developed markets like Europe.
They're already refining the details.
Right.
The EBA, the European Banking Authority, is working on the technical standards for MiCA. That's their big markets in crypto assets regulation.
Getting into the nitty-gritty.
Exactly. Right now, they're focusing heavily on stablecoins, pushing for really robust, highly liquid reserves, making sure they minimize liquidity risk, concentration risk. It just shows how mature the conversation has become. It's not if we regulate anymore, it's how do we manage the specific risks in detail. And this global trend, this convergence towards a unified FATF compliant standard, it's just a massive de-risking event for institutions everywhere.
Okay, so putting it all together.
I think you really should see the current price action less as a threat and more as a constructive rebalancing. The market's shaking out some of the short-term speculation, the froth. But at the same time, it's confirming that this new market structure, the one dominated by institutions, is actually pretty durable. It's resilient, and it seems ready for the next potential move higher.
So as you watch things unfold in the coming days, here are the 3 key signposts we think you absolutely need to keep an eye on. First, obviously, the defense of that critical $117,000 to $120,000 support zone. Does it hold?
Okay.
Second, watch those spot ETF flows. Do they continue even after this little pullback? That tells us if the big buyers are truly strategic long-term allocators or if they were just chasing momentum.
Yeah, that's a key test.
And third, keep tracking that corporate treasury story. Is it really shifting away from relying on just one big buyer towards these more diversified, integrated strategies? We suspect the answer is already yes, but watch for more confirmation.
Agreed.
Okay, and finally, let's leave you with a provocative thought. We saw the private equity giant KKR recently buy OSTTRA. That's a company providing traditional financial market plumbing, post-trade infrastructure, for $3.1 billion.
Big valuation for traditional rails.
Right. So when you see that kind of value placed on the old infrastructure, and then you see City Ventures putting money directly into the new digital rails like BVNK, well, you have to ask yourself, does the market now view digital infrastructure as being just as essential as the old stuff? Or maybe, just maybe, even more crucial for the future? Something to think about as this whole financial world keeps evolving.